This presentation talks about the taxability of pension distributions and something called the simplified method of calculating the taxable amount of a pension distribution. When we talk about pension distributions, these refer to employer plans and annuity distributions. And that differentiates those distributions from IRA distributions. Employer retirement plans are also known as defined benefit plans, and they are basically a trust that is set up by the employer, funded and administered according to plan documents. Contributions to an employer plan can be made by the employer, also by the employee, with either before tax or after tax dollars, or a combination of both. Distributions from employer retirement plans, which are governed by the plan document, can be paid out either at retirement age, in which you'd see a code 7 in box 7 of the 1099-R, also known as a normal distribution. You would possibly see a disability, which would be paid out possibly prior to retirement age. You'd see a code 3 for disability, and you would see a code 4 for a death benefit. We see quite a few of those. Separation of service is another possibility that you might see, a code 2. I have not myself seen very many code 2s, if at all, so those are fairly rare. And you also need to know that the trustee handles all distributions. So the distributions are always paid out by the trustee. Let's talk about annuities. Annuities are payments made under a tax advantage contract from either an insurance company, a trust company, or perhaps even an individual. Retirement plans, including IRAs, do have the ability to purchase annuities for retirees that would keep them strictly within those plans. So the IRA may have an annuity inside of it. The employer retirement plan may have an annuity inside of it. Annuity distributions usually are fully taxable. However, if a taxpayer has basis in the annuity, in other words, if the taxpayer has contributed after-tax dollars to their employer plan, the basis portion of that annuity is not taxable when it's distributed. Let's talk about two specific situations that you would encounter at your site as part of the interview process. So we're going to look at a Form 1099-R that you perhaps would have received from one of your taxpayers, and it could reflect two different scenarios. So the first one being that the 1099-R is clearly a pension because it does not have the IRA box checked. So that would be the case in either one of these scenarios. We're not talking about IRAs here, we're talking about pensions. So when you do not see the IRA box checked, you can pretty much assume that what you're looking at is a pension distribution. So in the first case, the taxable amount provided in box 2A, there is an amount there. So you do see a taxable amount in box 2A, but then when you look at box 2B, which is a checkbox, you notice that the checkbox is not checked. Now that checkbox, the first one, box 2B, is for the taxable amount not determined. So if you see a checkbox you see a check mark in that box, you can rest assured that the taxable amount has not been determined, or the payer is not accepting responsibility for the amount that's in box 2A. So in that case, if the box is not checked and you do see an amount in 2A, you can input that pretty much as you would a W-2. You just take the information that's on there, input it into TaxSlayer, and you're finished. Now the other scenario is that the taxable amount is not provided in box 2A. So that's box 2A is blank, box 2B is checked, so thereby they're telling you that the taxable amount has not been determined. So clearly incumbent upon you as a preparer to determine what the taxable amount is for that particular 1099-R. So when you see a situation like that, you should look at box 9B on the 1099-R and see if there's an amount in there, because those are the employee contributions. That is the amount of money that the taxpayer has contributed to his or her own retirement plan over the life of their employment with that employer. So that money was paid with after-tax dollars and should not be taxed a second time when they receive their distributions after retirement. So in that case, we use the simplified method to calculate exactly what the taxable amount is. So now we're going to get into how we do the simplified method. So there is certain information that we're going to need to know when we do the simplified method calculation. First of all, the gross distribution amount. We're going to get that from the 1099-R. The cost in the plan, also known as the basis, which are the total contributions that the employee made during the lifetime of their employment with the employer. So that's their basis in the plan, and that's what they paid in after-tax dollars over the years. The annuity start date provided by the taxpayer or documentation. So if you don't already know what the annuity start date is, you need to ask the taxpayer. And single life or multiple life. So when people sign up for their retirement plans, they usually make a choice between whether they want the retirement plan just for their single life, for themselves, or for themselves and their spouse. So you need to know what decision was made back when they first signed up for the plan, and that will be used in the simplified method calculation. Additional information required. The annuitant's age on the date that the annuity began. This is important. The annuitant's age has to be on the date that the annuity began, not December 31st, as we usually use. That's the date we usually use when we talk about taxes, is the taxpayer's age on December 31st. So this is, however, the age on the date that the annuity began. Also, if it's a joint survivor annuity, the spouse's age, we also need to know that age on the date that the annuity began. The amounts previously recovered. So those are the amounts that were previously not taxed. So if they had filed previous tax returns that had amounts that were not taxed, those need to be accumulated and need to be placed into the calculator as well. The number of months payments received in previous years. So if we know how many months they had received payments in the years prior to the current year that we're doing taxes for, we need to know that information as well. Now note at the bottom of this slide that with regard to the annuitant's age, if the taxpayer died and did not receive any payments, any retirement distribution payments before their death, then we use only the spouse's age and not the combination of the two of them. So calculating the taxable amount, we have two different calculators that we need to talk about. First of all is the pension calculator within TaxSlayer. So when we enter a 1099-R within TaxSlayer, we have a button that we click on that brings up a pension calculator, and we input all of those things that we had just gone through in the previous two slides. So that pension calculator works fine, and the only problem with it is that it does not calculate the taxpayer's age at the pension start date. So that's a piece of mental gymnastics that we have to go through in order to use that calculator. We have to stop and think, okay, how old was this taxpayer when they first started receiving payments from their pension? And that, unfortunately, is prone to mistakes because it's not, you have to stop and think. So if we use the next thing on the slide, the Bogart pension calculator, the pension calculator will calculate that for us because we enter the actual annuitant's age and the spouse's age, and it will then calculate everything. So we don't really have to stop and think, okay, how old was this person on that particular date? Now you can see Jeff Bogart is a gentleman, he's one of our volunteers in Colorado who has created a whole a bunch of tools, software tools, because he was a software engineer in a prior life. And one of those tools that he's created is this pension calculator. And you can get to it by going to the website that you can see it displayed on the slide. We also have a link to that tool on the Mass Tax-Aide website, mataxaide.org. So on the right-hand side of the first screen you get to on masstaxaide.org, you will see the button that you can click on to go to his calculator. And I also actually put a shortcut on my desktop that gets me right to his calculator, so that makes it easy as well. So you enter the taxable amounts from the completed Bogart calculator. We're going to go through the calculator itself in the next few slides, but when you do the Bogart calculator and you finally get to an answer as far as how much is excludable and how much is taxable in the current year, you just then go to TaxSlayer with that information and you put it right into box 2A, and you can be finished at that point, or as you'll see in the next slide, there's an alternative that I want to talk to you about as well. Nice thing also about the Bogart calculator is that it prints out a report, and you can include that report with the taxpayer's tax return, and you can refer to that in future tax years. So calculating the taxable amount, this is a recommended option, at least it's my recommended option. You can use the Bogart pension calculator, but do not enter anything in the taxable amount in box 2A of the 1099-R in TaxSlayer Online. Instead, you're going to click on the TSO pension calculator, which is just below that box 2A. And when you click on that pension calculator, you can then take the amounts from the Bogart calculator and put them into the various fields in the TaxSlayer pension calculator. And the advantage to that, of course, is that this will then, from that point forward, take the excludable amount automatically in future years will be deducted from the taxable amount. So I don't think anybody's actually seen this work. We've been promised by the TaxSlayer development people that this will in fact work in future years, but we really have no proof of that at this point, so we're kind of keeping our fingers crossed that will be the case. So let's go through an example scenario. We have two taxpayers, John and Phoebe Phillips, and John is a retired public safety officer. John began collecting his pension on July 1st, 2016, and the gross distribution amount that he received this year in 2019 is $14,000. Total employee contributions over the years that he worked for his employer was $48,483. John's date of birth was November 1st, 1953. Phoebe's date of birth was March 27th, 1967. And the health insurance premiums that he paid in 2019 were $3,875. Before we go any further, we need to talk about the public safety officer and what they qualify for. As a public safety officer, they qualify, once they retire, to be able to deduct their health insurance premiums from their pension each month. And that excludes that amount from being taxable at the end of the year. Taxpayers, the public safety officers usually know this, and they will make you aware of it if you don't pick up on it yourself. They can deduct up to $3,000 from their insurance premiums, and that $3,000, actually, let me take that back. They can deduct more than $3,000 from their retirement pension, but the tax code allows them to get this deduction from their taxes of $3,000. So we reduce the Form 1099-R Box 2A by the amount of $3,000 or less, if it happens to be less, but typically these days it would be more. And then if there is excess above the $3,000, that excess can be used as a medical deduction on their Schedule A for itemized deductions, assuming that the medical that the itemized deductions exceed the standard deduction. Otherwise, of course, the medical deductions wouldn't be used. So, self-employed health insurance also is another option that if they happen to be self-employed, they can use that as an adjustment to income. So again, it would be the excess over the $3,000 that would be used as a self-employment adjustment to their income. So it can be either or, but not both. You can't put it on your Schedule A and use it as a self-employed deduction. So here you can see John Phillips' 1099-R and from the Baker County Police Department. And you can see that his gross distribution of $14,000 appears in Box 1. Box 2A, the taxable amount is left blank. And Box 2B, you can see that the taxable amount is not determined. When you see a check or an X in Box 2B, the taxable amount has not been determined. So that's the clue that tells us that we have to determine the taxable amount ourselves. So you can see that it's a distribution code 7, so it's a normal distribution. And in Box 9B, you have the total amount that he paid into his retirement plan over the years, $48,483. And again, that was paid with after-tax dollars, so that's the amount that we want to be sure is not taxed the second time around. So that's his 1099-R. Here we have the Bogart Annuity Pension Exclusion Calculator. This calculator is pretty straightforward. You simply take the information that you've accumulated about your taxpayer and you plug the information into the various fields. So we'll go through the fields one at a time. So here you have the tax year. Make sure you select the appropriate tax year for your taxpayer. Here you can put the name and this box check if public safety officer. So in John Phillips' case, of course, he was a public safety officer, so you would check that box. Also, you have a box here called check if disability pension. So if you had a pension that was marked code 3 in box 7 for disability, you would check that box because then the calculator can actually determine whether the distribution for that particular year is considered wages or whether it's actually a pension. We'll talk more about that later on. So you have the annuity start date here, July 1st, 2016, and the annuitant's birthday, November 1st, 1953. Notice these boxes over here, check if deceased, and also died in 2019. So if either one or both of those applies, you would check those boxes. Notice here the spouse's birthday. Now, if this is a single annuity, you would not fill anything out here. You would not put anything in the spouse's birthday, but in this case, it's a joint survivor annuity, so we are going to put the spouse's birth date. And that tells the calculator that this is a joint survivor annuity. So if you put a birth date in this field, it is going to automatically assume that it's a joint survivor annuity. So if it is not, make sure you do not put anything in that field. And then we move down to gross distribution, $14,000. Notice here that if it's railroad RRB 1099-R, you want to check that box because it's handled differently. And the total annuity contributions that this employee paid into their retirement plan over the years is $48,483. The annual cost of insurance for 2019 was $38.75. And then you see these boxes here, as well as these boxes and this message, do not show up until you finally click here to calculate. So those boxes are blank until you click on that button to calculate. So that is pretty much it for the first screen. Now keep in mind that what you're seeing on your computer is going to be all in one screen, and it's going to require you to scroll down. I have broken the whole thing into 3 separate slides so that you can see it clearly, but what you're going to see is going to require you to scroll. So we're going to move on to the next slide. So here you see the taxable amount, $93.84. That's the amount that is going to be taxed out of his $14,000 gross distribution. Now over here you notice the simplified general rule worksheet. All of the information in this worksheet can easily be plugged into the calculator in TaxSlayer. And that's what I recommend that you do. So rather than taking this amount here and plugging it into box 2A, what I would suggest is that you take all of these amounts, plug them into the TaxSlayer calculator, then the TaxSlayer calculator will automatically make an entry into box 2A. Notice also down here about the medical expenses. $3,875 is over the $3,000 that's allowed, so there's $875 that can be applied to Schedule A as itemized deductions, or it can also be used as a self-employed health deduction. So we're going to move on to the next slide. Okay, notice here that this is the exclusion table for John Phillips. So this is a table that basically describes what's going to happen for the next 27 years on his tax returns. So it starts off with $808 being excluded from being taxed in 2016, and then as you can see, it goes immediately to $1,616 each year thereafter, with the exception of the last year down here, $811. So the first and the last year are going to be some odd amounts, but for the most part throughout this whole cycle, all of these exclusion amounts will be the same. So if you were to get someone that came in, and had been getting their pension distributions for some period of time, and you're dealing with them for the first time, but you can see from their prior year tax return that they had $1,616 excluded, you could very safely assume that the current year exclusion would also be $1,616. So you would take the gross amount from the 1099-R, subtract $1,616, and then you would put that result into box 2A of their 1099 in TaxSlayer. So you don't necessarily always have to do this simplified method calculation. This is primarily for the first year, and then after that you could follow suit. And TaxSlayer will also, as I'm told, we haven't actually experienced this, but TaxSlayer will be able to carry that exclusion amount forward from year to year from here on. Okay, now we're in John and Phoebe Phillips' tax return, and the next step is that we're going to edit their 1099-R and calculate the taxable amount using the TaxSlayer annuity exclusion calculator. So here we go. The return has already been prepared partially, and we're going to go to the federal section, and we're going to go to retirement income. We already have a 1099-R there from the Baker County Police Department. Notice it says incomplete. So we want to edit that 1099-R, and we can see that we've got it here. Notice that the gross distribution and the taxable amount are both the same. That's exactly what TaxSlayer does. It takes the gross amount and duplicates it to the taxable amount, so it makes the assumption that the whole thing's going to be taxable right from the start. If that's not the case, we as tax preparers need to determine what that taxable amount is. So the way that we do that is, notice it says here, do you need to calculate your taxable amount? Click here for options. So we click on that. Notice we have a couple of calculators here, the simplified method worksheet and the public safety officer distribution. Not sure, but I think the public safety officer is part of the simplified method, so I don't think we need to do both, but we'll see. So we're going to do simplified method. You must use the simplified method if your annuity start date is after July 1st, 1986, and you used this method last year to figure the taxable part. Also, you must use the simplified method if your annuity start date was after November 18th, 1996, and both bullet points below apply. The payments are for one of the following: a qualified employee plan, a qualified employee annuity, or a tax-sheltered annuity plan, 403B. On your annuity start date, at least one of the following has to be true. You are under age 75, or you are entitled to less than 5 years of guaranteed payments. You cannot use the simplified method if you receive your pension or annuity from a non-qualified plan, or if you do not meet the conditions described above. If you do not qualify to use the simplified method, you should use the general rule to figure your taxable amount. For more details about the general rule, you can click on that button. If you are eligible to use simplified method, click the continue button. If you do not qualify, you can click the cancel button. A little point about the general rule. First of all, it's out of scope for Tax-Aide, and it's also far more complicated than the simplified method. So in either case, we don't want to get involved with the general rule. I guess we need to know that it exists. However, we don't need to learn anything about it because we're not going to use it. So we're going to move on to the simplified method by clicking continue. Okay, here you have a worksheet. It tells you the gross distribution amount is $14,000. The plan cost at annuity start date is the amount that he contributed over the course of his employment, $48,483. The start date of the annuity is July 1st, 2016. July 1st, 2016. Click here if this is a joint or survivor annuity, and it is. Death benefit exclusion, nothing here. Age of recipient at start date. So here you can see that you either have to figure out what his age was at the start date, which is prone to mistakes, or you can take the information from the Bogart calculator, which is exactly what I'm doing. So if joint or survivor annuity, you're going to add the ages of the recipients together. So that's already been done for us in the Bogart calculator, and we determined that it's 111 years combined. So the number of months paid in 2019, and that also comes from the Bogart calculator. On the right-hand side, there's a box that says Simplified General Rule Worksheet. It says number of months paid in 2019, 12. Amounts previously recovered, that's also right there, 4,040. Public safety officer exclusion. So this is right here on the same worksheet, and that public safety officer exclusion is $3,000 because he cannot receive any more than that based on the law. And that's everything as far as filling out that worksheet. We click on continue. Notice the taxable amount here, $9,384. Tells you what the start date of the annuity was. Click continue to use the calculated amount on your 1099-R. Click delete to delete the worksheet and return to 1099-R. So we're happy with this. It turns out the taxable amount comes out exactly as it did in the Bogart calculator, so we're good there. We click on continue. And here's our 1099-R, and notice box 2A now has a taxable amount of $93.84. So we don't have to actually physically change it ourselves. The worksheet did that for us. And there's nothing left to do. So we've got the federal tax withheld, $800. That was done previously. We've got the box 9B amount has been placed in there. Distribution code 7. So all of this had been done previously. Now you would probably do this all in one step yourself. So that's all the information that you should need. Click continue. And there's a note here that says the taxable amount entered is less than the gross distribution. If the distribution was part of an annuity plan where part of the total distribution is not taxable, then please select continue below, and that is exactly the case. So you're going to get this message anytime those two amounts are different, and it's just a heads up for you to make sure that you're doing the right thing. Okay. And then if we go to summary print, we should see 9384, and we do, taxable amount right here, box 4B, 9384. So that's the simplified method, and that's how you handle it in TaxSlayer. So once the taxpayer becomes roughly in their mid-80s, the pension is fully taxable after the basis is completely recovered. So as you saw in the table, once they get to roughly 85 years old, then everything becomes taxable from that point forward. There's one exception, of course, that's the annuitants who retired between July 2nd, 1986 and December 31st, 1986. And their taxable amount is permanently reduced, so they never get to the point where they're paying tax on the whole thing. Here's a special case scenario, disability pensions. So until a taxpayer reaches the employer's plan retirement, minimum retirement age, their pension is reported and taxed as wages. Once they get to that minimum retirement age, then they're going to start being taxed as retirement income. So until they get to that minimum retirement age, that income is reported on line 1 as wages and is actually usable as earned income for things like the earned income tax credit. So even though they're disabled and they're too young to actually retire, they are considered to have that income as wages. Once the minimum retirement age is reached, disability pension reported and taxed as pension. The disability pension is reported as a code 3 in box number 7 on the 1099-R, and you need to confirm that the minimum retirement age of the plan, civil service 1099 marked disability. So taxpayer does not start to recover their basis until it begins being taxed as a pension. So if they get a disability when they're younger than minimum retirement age, and again, that minimum retirement age depends on their employer. Some employers call the minimum retirement age 62, others call it 65. So they don't start recovering, they don't start excluding anything from taxability until they actually reach their minimum retirement age. Now, railroad retirement, Tier 2, minimum retirement age depends on years of service. And you can see here 30 years of service or more. They retire, actually the minimum retirement age is 60, and then 30 years of service, it becomes 62. Civil service pensions. Box 5 is either health insurance charges or basis that recovered this tax year, if the taxable amount determined by the payer. So you need to ask the taxpayer about box 5 if you see an amount there. Ask if they can identify the source, whether it be health insurance or whether it be their basis that they paid in that particular year. Self-employed health insurance adjustment. So if it is health insurance, it will qualify as an itemized deduction on Schedule A, assuming that they have enough itemized deductions to beat the standard. Also, they can use it as a self-employed health insurance adjustment to gross income if they're doing a Schedule C. Now, here's another case, zero taxable. Box 1 has a gross amount. Box 2A has 0, but it's not blank. Box 2B is not checked, so the taxable amount has been determined, because if the box 2B had been checked, it would be taxable amount not determined. So the taxable amount has been determined, and it's been determined to be a 0. So you enter 0 in the taxable distribution on box 2A in TaxSlayer.